Hi friends, we are seeing investment decision, project planning and control, chapter number 1 from SFM, paper number 14. We have seen 3 methods from discounted cash flow method, and now we are going to see the 4th method, that is adjusted net present value method. What is the formula for adjusted net present value? NPV plus present value of tax saving on debt minus present value of flotation cost of equity. So in NPV method, we will find the net present value using the present value factor. Similarly, in this method also, we have to find the present value, net present value, and then we have to find 2 other things which need to be added to the net present value. That is the present value of tax saving from debt financing and present value of flotation cost of equity. What it means? So cost of investment is the amount which is invested in the project. So for investing in the project, what is the source of income? It is by debt or by equity. So if we receive money through debt, if we borrow money, what we will pay? We will pay some interest for that amount. So if we are paying the interest, we will get tax saving. So that is the second step they have given. So we have to find the present value of the tax saving amount, and then if we are issuing the equity shares, we will occur some cost. That cost we have to find the present value. With this NPV, we have to add the present value of tax saving and we have to deduct the present value of cost of equity. Okay, let's start an illustration number 12. A firm is considering a project requiring 50 lakh of investment. So the cost of investment amount is 50 lakh. Expected cash flow is 10 lakh per annum for 8 years. So for 8 years, they are receiving uniform cash inflow of 10 lakh per annum. The rate of return required by the equity investor from the project is 15%. The firm is able to raise 24 lakh of debt finance carrying 14% interest for the project. The principal amount of debt is repayable in equal annual installment over the 8-year period. The first to be paid at the end of the first year. The tax rate is 40%. Calculate adjusted NPV and advice. So here, what is for finding the NPV? What is the cost of capital? 15%. Then they have given the firm is able to raise 24 lakh of debt finance carrying 14% interest for the project. That means out of the 50 lakh, they have raised 24 lakh using the debt finance and remaining 26 lakh using the equity, by issuing equity. So for 24 lakh, they are paying 14% interest. And then how they are paying this 24 lakh? By equal annual installment. That means 24 lakh they are paying equally for 8 years. So 24 lakh divided by 8, we will get 3 lakh. So they paying annual installment of 3 lakh per year, excluding the interest amount. Then they are paying at the end of the first year. Next, the tax rate is 14%. Why they have given 40% tax? We need to find the tax saving on the interest amount. Let's start solving the illustration number 12. First, we have to find the NPV. In question, they have given expected cash flow is 10 lakh per annum for 8 years. Here they have stated the 10 lakh is uniform for 8 years. So no need to find the present value for 8 years separately. So we will find by combinedly for 8 years using the present value annuity factor. So we have to multiply the present value annuity factor into the inflow amount. So how to find this present value annuity factor? 1 divided by 1.15, that is 1 plus 15 by 100 is 1.15. So 1 divided by 1.5, power of 1 is for first year and power of 2 is for second year and 3 is for third year, and like that we have to find the present value factor for 8 year. Then add these 8 year present value factor, we will get 4.4873. So multiply the cash inflow into 4.483, subtract the cash outflow, that is present value of cash inflow minus present value of cash outflow. So we will get minus 5,12,700. Let's show how we will calculate these present value factor in calculator. So 1 divided by 1.15, that is 1 plus 15 percentage is 1.15 equal to, so this is for second year. If we press equal second time, it is for second year, third time it is for third year. So for 8 times we have to press equal symbol. So 3 given, 4, 5, 6, 7, 8. So till 8 year we have given, then press GT. So this is the present value annuity factor for 8 year for cost of capital 15%. Let's start step 2. Step 2, we have to find the tax saving on debt amount. So 50 lakh is the cost of investment. This 50 lakh is financed by 24 lakh debt and 26 lakh remaining equity. Okay. This 24 lakh debt is repayable in equal installment for 8 year carrying interest of 14%. These calculation is given below. So outstanding for the first year, the outstanding amount is 24 lakh. So for 8 year equal installment means 24 divided by 8, we will get 3 lakh. So first year we will pay 3 lakh. So after deducting the 3 lakh, outstanding amount will be 21 lakh. So after deducting 3 lakh, outstanding amount for third year is 18 lakh. Fourth year is 15. Like this we have to deduct the 3 lakh from the outstanding amount. Then how we will pay the interest? We will pay the interest on the outstanding amount. So first year outstanding amount is 24 lakh. So we will pay 14% interest on the 24 lakh, that is 3.36. Then what is the tax amount given in the question? 40%. So 40.36 into 40%, we will get 1.344. Then for this tax amount, we need to find the present value factor. So when we calculating the net present value, we consider 50% for finding present value. Here debt percentage is 14%. So we need to find the present value factor using this 14%, not on 15%. Then we will get a discount factor for 14%. Then we have to multiply the tax amount into discounting factor for all the year, for all the 8 year. Then when we add these present value of tax amount, we will get 4,03,270. Okay, let's see step number 3 in the adjusted net present value method. So I have already stated 50 lakh cost of investment is financed by 24 lakh debt and 26 lakh equity. So we have to find the cost of equity. So in the question they have not given any cost of equity. So we assume cost of equity as 5%. So this 26 lakh is excluding the 5%. So 95%. So when we deduct the 5% from the 100, we will get 95%. So 95% is the 26 lakh equity amount. So if for 5%, we will get 1,36,800 something. So in book they have rounded off and given us 1,37,000. Here I have written the step 1, step 2, step 3 answer. Step 1 is we have calculated the base NPV, that is minus 5,12,700, and then in step 2 we have found tax saving on debt, that is 4,03,270, and step 3 we have found cost of equity, that is 1,37,000. Here in step 2 we are paying the interest on debt. If we are paying the interest, it is a tax saving for us. If it is a tax saving, it is a cash inflow. Okay, then if we are receiving any interest, then we will pay tax and it is a cash outflow. If we are here we are paying the interest on debt, so it is a tax saving, it is a cash inflow. If it is a cash inflow, we will add these tax saving amount. Cost of equity is we are paying on the equity, so we have to deduct this amount. So NPV already in the negative, then since it is a cash inflow, we add this amount, then we deduct these cost, we will get minus 2,46,430. So what is the decision rule? If NPV is negative, we will reject the project. If NPV is positive, we will accept the project. Same rule will apply to adjusted NPV. Here, since it is adjusted NPV is in negative, we will reject this project.